All right, well, welcome to today's webinar on navigating inventory costs in today's uncertain time. In an era where economic unpredictability is the norm, managing inventory cost is a critical focus for businesses. We're excited to have you here with us today. If you have any questions at any point, please feel free to use the Q&A box located below. Towards the end of the presentation, you will be able to go off mute to ask any questions as well. Additionally, for your convenience, we are recording this webinar. For those who may be unfamiliar with Sensiba, we are a leading accounting firm ranked in the top 100. Our services encompass tax, audit, and various consulting services, including technology and sustainability solutions. In addition, we take pride in being a certified B Corp and have been serving our clients for over 40 years. Now, I'd like to introduce our team today. First, we have Keith West, our audit director with over 8 years of audit and accounting experience. Keith specializes in assisting closely held businesses in balancing tax and financial reporting objectives. His expertise spans various sectors, including construction, technology, and manufacturing. Keith's commitment to understanding his clients' businesses is evident in his advice on critical accounting aspects such as revenue recognition, consolidations, foreign currency transaction, and inventory valuation. Joining Keith is Kevin Burke, our Senior Internal Audit Manager, with an impressive 20 years of experience. Kevin excels in SOX implementation, operational auditing, and financial close process improvement, including Blackline systems implementation and consulting. His skills in risk assessment, control design, and optimization make him a trusted advisor to mid market and enterprise organizations, particularly in technology, construction, hospitality, and biotechnology industries. Throughout today's webinar, Keith West will be our primary speaker, and Kevin is here to answer any questions you may have. So without further ado, I'll pass it off to you, Keith.
All right, thank you so much, Louie. So we have a jam-packed agenda for you today. So first, we're going to talk about adapting pricing to inflation. Then we'll discuss some understanding macro and microeconomic uncertainty, followed by some costing accuracy, best practices for overall inventory costing, best practices for standard costing, then some demand forecasting, some risk mitigation strategies, and we'll talk about some technology and automation. And finally, we'll wrap it up full circle with some pricing decisions. So this presentation was born from observations and questions posed over the last couple of years, specifically regarding the challenges with standard costing during periods of price volatility. In October 2022, I wrote a blog about best practices regarding the topic. The information covered in today's presentation will be broader in scope and is meant to be very high level. Each bullet point in this agenda could be a seminar in and of itself. So pricing when inflation is rising. Nearly all of my clients, manufacturing, distribution, or otherwise, raised their prices last year as a result of rising input costs. Even the owner of the pizza shop near me, who last year proclaimed, "In the last 15 years, I've never raised prices on the lunch special." It was a slice of pepperoni and a Coke for $3, raised his prices recently. So when should prices be raised? Precision pricing is the key to pricing in today's inflationary environment. Traditional broad price increases, which treat all costs the same, is less effective. For manufacturers using standard costs, which are typically set annually, in an inflationary environment where various input costs are rising, management is forced to rely on the company's standard costs, which can prevent them from seeing the actual cost of each product. This can also be true for manufacturers using weighted average costing, which merges unit costs from different accounting periods, obscuring period-to-period comparisons. Since accurate costs are essential in pricing products, managers are forced to simply declare across-the-board price increases, which are difficult to enforce and often cause widespread ill will. This can be avoided by utilizing enterprise profit management analysis for your customer base. The EPM model at a high level breaks customers down into three broad profit segments. Bucket A is your high revenue, high profit customer. It's typically 20% of your customer base that generates about 150% of your profits. Then you have bucket B, your high revenue, low profit customers. That's about typically 30% of your customer base, but it erodes about 50% of these profits. Then you have your low revenue, low profit or loss customers. That's bucket C. So for example, let's say shipping prices doubled. Across the board price increases on your high revenue, high profit customers that purchase a high profit, low weight product might be counterproductive and damage that relationship with that customer. Let's say another company in bucket A purchases profitable but low value, high weight products in bulk. Serious consideration would be needed to determine if shipping price increases would be temporary or if they warrant a proactive discussion with the customer about pricing. A customer in bucket B with high revenues but low profits might be an opportunity to convert into a bucket client by approaching the customer with a proposition to say, avoid a general price increase by reducing the frequency of their orders, thus improving operating costs. Utilizing this method also focuses on the right customers and seeks opportunities to increase customer profitability. In order to implement an EPM strategy, management needs to first consider costs, as accurate costs are essential for pricing products. The first step in costing during periods of uncertainty and inflation is understanding the macro and microeconomic challenges. I took an international economics course in college. On the first day, the professor opened up the course with this question: what do corn tariffs in Iowa have to do with suicide rates in India? A morbid but poignant question that served as the backdrop to explain the interconnectedness of the global economy. COVID-19 has shown how complex and fragile our supply chain networks can be. So translating the headlines into what this could mean for my business is essential. So for example, Norway in July announced that they had discovered a massive underground deposit of high-grade phosphate that is enough to satisfy world demand for fertilizers, solar panels, and electric car batteries for over the next 50 years. How will this impact input prices going forward? Just this week, it was announced that in December, prices increased approximately 3.4% compared to December of 2022. And the Financial Times reported that the Fed is expected to hold interest rates steady throughout the summer. Does this result in an update to your demand forecast model? Staying connected to industry groups, tracking shipping and commodity rates, and macroeconomic forecasts will assist your teams with making timely costing decisions. Accurate costing is crucial for profitability, decision-making, pricing strategies, and financial reporting. In addition, it helps with process improvement, sourcing and hiring, procurement and budgeting, and forecasting. The first step in costing accuracy is to identify and categorize costs into variable, stepped, and fixed costs. Knowing the difference between these three assists with calculating break-even points and contribution margins. Another is overhead allocation. There are different methods of allocating overhead costs, such as using predetermined rates based on direct labor hours, machine hours, or units produced. However, these methods may not reflect the actual consumption of overhead resources by each product and may result in under or over costing. Therefore, you need to choose a method that best suits your business model, your cost drivers, and your product mix. The worst example of a fixed overhead allocation I've observed was a company using a rate of $2.15 per labor hour. Why? Because Frank had once worked at ABC Corp, and that was the number that they used. One of the more advanced methods in manufacturing cost analysis is activity-based costing, or ABC costing. ABC is a technique that assigns costs to products based on their activities that they require, rather than on a simple allocation basis. For example, instead of using a single overhead rate for all products, ABC costing would identify the different activities that each product involves, such as design, testing, packaging, and delivery, and assign costs to each activity based on the resources they consume. This method provides greater accuracy, but also requires detailed record keeping compared to other methods. Even if you don't have time and or the resources to implement ABC costing, Monthly cost variance analysis, comparing your actual costs to your budgeted or your standard costs, can help you monitor and control your manufacturing performance and identify any problems or opportunities for improvement. Adopting accurate cost accounting methods offers a range of benefits, from improving decision-making processes around pricing and offerings to optimizing resource allocation and reducing overall operating expenses. Data collection and analysis. There's an old saying, garbage in, garbage out. You can scenario plan and break down costs until you turn blue in the gills. But if the information going into the analysis isn't accurate, the results can't be relied upon. The highest data quality provides a certain level of confidence to all who depend on the data. If data quality is high, the users will be able to produce better outputs. Data accuracy leads to lower costs. Furthermore, data accuracy is a prerequisite for implementing artificial intelligence and machine learning. Common errors I've observed recently were costing being input into the ERP system using foreign denominations. Euros and pounds might not cause that big of variances, but yen would. Inconsistent treatment of freight in, customs, duties, and other taxes, stale overhead rates, and outdated bill of materials that didn't match the batches being produced or weren't updated for changes in scope. These inaccuracies led to book to physical differences, resulting in more inventory on hand than needed of a particular part due to faulty data. A well-crafted bill of materials is essential for any manufacturer, regardless of the size or product complexity. Scenario planning. You want to develop different cost scenarios based on macro and microeconomic factors to assess potential impacts. Then conduct sensitivity analysis to understand how changes in variables affect overall costs. Start with the best case and worst case scenarios. Limit yourself to 4 scenarios and focus more on the assumptions than the numbers. Find choke points. So while we were assisting a brewery with forecasting, we found that fermenters were their choke point. So they built out a brew schedule by fermenter and adjusted their product mix and business hours to ensure that they would not run out of beer. Their initial business plan called for multiple lagers on the menu. However, lagers take double the time to brew and would lock up their fermenters. The lead time needed to build up a sufficient inventory of lagers would erode their operating capital before they even opened their doors. Thus, they modified their product mix. Their revenue without contract brewing also had a natural ceiling based on the production capacity. The brewery utilized 4 scenarios that focused first on breaking even. Their actual performance was closer to the best case scenario and also required them to pivot and make adjustments multiple times. You also want to factor in seasonality into these models, your production capacities, downtime for maintenance, and critical components. During COVID, a client lost out on a 7-figure contract because they were not able to secure supply of a common but critical component of their product. So while we're all happy that the pandemic has ended, the lessons learned should not be forgotten and worked into these scenarios. Also, I want to remind you not to ensure that your scenarios are not too complex or simple. Flexible cost structures. Developing a more flexible cost structure starts with gaining a better understanding of the exact source and size of different expenses. It has been said that 80% of a company's spend goes towards about 6% of their suppliers. COVID-19 has shown that manufacturers need to be what I like to call leanish. And that is the practice of that is practicing lean manufacturing with caveats for critical items with longer lead times or that are expected to have price increases. Flexible cost structures best practices include reviewing your product mix. Will a certain offering hold greater appeal to customers? During a downturn, it's all about maximizing margin and controlling variable costs. That shift could mean temporary halting production or availability of certain goods. You want to prioritize your scenario planning. Next, you want to consider possibly leasing more assets. While this can be more expensive, it'll allow a company the ability to stop paying for a resource that it no longer needs. Building a contingent workforce. Workers who are not on the company's payroll offer a much greater flexibility than full-time employees. Utilizing temporary workers when possible allows for quicker scaling and contracting. And you want to establish alternative suppliers and avoid single source suppliers where possible. So when should you update your standard costs? Standard costs are traditionally set annually. This practice works great in times of price stability. The question is, how often should management be reviewing their standard costs to properly evaluate product and customer profitability? The process of reviewing and updating standard costs can be time consuming. Management needs to ensure that before they consider updating standard costs, that their monthly review of positive and negative variances is timely and accurate. Management should consider resetting standard costs during periods of input price volatility, during periods of economic uncertainty. Budgets prepared may not remain relevant during the year. I mean, everybody's budget went out the window in 2020 during COVID. When changes in output are identified, and when non-temporary input prices are identified. When the changes above are identified, the default practice is to revise the standards either biannually, quarterly, or even monthly. Again, this process is time consuming and may not be necessary to complete on a monthly basis for all of your standards. In addition, changing standard costs too frequently might cause management to inadvertently reflect temporary variations in their costs, which would lead to unnecessary variances in analysis. Other methods for reviewing and updating standard costs include selectively adjusting standards on an increased frequency, which can be done by utilizing the Pareto principle. The Pareto principle can be applied by analyzing and updating the 20% of the items that make up 80% of your costs. For one client, their purchase price variances were almost all related to steel and sheet metal. Analysis of their other components, which were not impacted as significantly by inflation, would have bogged their team down. You can also utilize the triggering event approach, which is determining a specific threshold of change that triggers an analysis of your cost variance. For example, management will analyze and update any cost that fluctuates by 25% or more of the budgeted cost, or any cost that comes over a defined dollar value. So here are some tips for standard cost analysis. Examine costs every month. Pull the accurate and complete data to build an analytical fact base. Be flexible and inquisitive. Cost benefit principles should be considered throughout the analysis process in order not to get bogged down in the details. Remember not to interpret variances in isolation of each other. The causes of variances in one part of the value chain can be the result of a decision made in another part of that value chain. Do not be misled by favorable variances. Favorable variances are often mistaken for good news. Be sure to understand the root cause. And you want to review and monitor your supplier contracts for limits on pricing adjustments. Some contracts have incentives to bring prices down, but suppliers may ignore these clauses until they're audited. Demand forecasting is the process of using predictive analysis of historical data to estimate and predict customers' future demand for a product. Demand forecasting helps management make better informed supply decisions that estimate the total sales and revenue for a future period of time. Demand forecasting plays a crucial role in manufacturing for several reasons. Production planning. Accurate demand forecasting allows management to plan their production schedules effectively. Inventory management. Demand forecasting helps management optimize their inventory levels. By predicting future demand, they can maintain the right amount of stock on hand, minimizing carrying costs and reducing the risk of stock obsolescence or shortage. Cost reduction. Effective demand forecasting helps management reduce costs in various ways. By aligning production with demand, they can minimize waste and avoid overproduction and optimize resource utilization. And supply chain efficiency. Demand forecasting enables management to streamline supply chain operations. With accurate forecasts, they can work closely with suppliers, ensuring timely delivery of raw materials and components, reducing lead times and improving overall supply chain efficiency. Best practices for effective utilization of demand forecasting include working with customers to proactively update demand, working with vendors to secure supply and lead times, updating the model weekly and reviewing the model monthly. Ensure that seasonality patterns, product mix, and customer and market trends are factored in to the model. This should include recent regulation changes such as AB 1200. Ensure that the right people are at the table. Collaboration between departments is crucial. By involving cross-functional teams, manufacturers can leverage diverse perspectives, expertise, and data from different areas of the business. Collaboration between departments, including sales, marketing, production, and finance teams, is key. Jointly review and refine forecasting results. To assist with procurement, consider building out pre-approval limits for your purchasing teams to streamline the ordering process. During periods of forecasting decline in demand, reconsider reorder points and ensure they are in line with the demand forecast. Risk mitigation strategies. So raw material prices are often highly volatile and can fluctuate rapidly, sometimes even doubling or tripling in price within a matter of months. Employing hedging strategies to manage exchange rate fluctuations and commodity prices. Hedging, while complex, can lock in prices and assist with avoiding volatile price changes. For example, Southwest Airlines for years has implemented a hedging program that helped them avoid sharp changes in jet fuel prices. During the Great Recession, Southwest used hedges effectively to purchase 70% of its oil at $51 a barrel, rather than paying a $130 price tag that other airlines paid. This can provide a level of certainty in uncertain economic conditions. There are several types of hedging tools that manufacturers can use to protect against price fluctuations in raw materials. Some of the most common include future contracts. Future contracts are agreements to buy or sell a specific quantity of raw material at a specified price and date in time in the future. By purchasing future contracts, management can lock in a price for their raw materials and protect against price fluctuations. Option contracts. So option contracts are similar to future contracts, but they give management the option to buy or sell a specific quantity of raw materials at a specified price and date in the future. Option contracts provide more flexibility than future contracts because the manufacturer can choose not to exercise the option if the market price is more favorable. And then you have forward contracts. So forward contracts are similar to futures contracts, but they are customized agreements between two parties. Forward contracts can be used to protect against price fluctuations in raw materials. Diversifying suppliers and production locations to reduce the impact of disruption in a specific region or supply chain. For example, in 2011, a client of ours was severely impacted by the earthquake in Japan. The earthquake disrupted the supply of a critical component, and their product and their supplier was a single source. This caused the company to delay deliveries and scramble to find an alternative supplier, costing them millions of dollars in revenue and additional expense. Develop contingency plans for possible economic scenarios to respond effectively to unseen events. Technology and automation. Leverage advanced technology and automation tools for data analysis, cost calculation, and scenario modeling. This can enhance the accuracy and efficiency of manufacturing costing and standard costing processes. While AI and machine learning get all of the attention, efficiencies can be gained by first understanding and utilizing the systems your company currently operates. Ensure that your teams are utilizing all of the modules of your manufacturing ERP. Understanding how costs flow through these systems is the first step in improving costing accuracy and making timely costing decisions. And finally, pricing decisions. As you can see, we've come full circle back to sales price. In the contracting process, you should screen your request for proposals for major products with potentially volatile inputs that would adversely affect your profitability in serving those customers. If a prospective customer is likely or certain to buy a number of products that would be affected by possible material cost increases that would make the customer unprofitable to serve, the contract should include escalators or guardrails that would ensure the prices are automatically increased to reflect any significant cost increases. If you're unable to provide accurate estimates of cost, consider cost plus contracts with your customers. Opportunities exist to forge new partnerships with customers, helping address any pain points while preserving your margins. In conclusion, navigating macro and microeconomic uncertainties requires proactive measures in manufacturing costing and standard costing. By adopting best practices, embracing flexibility, and leveraging technologies, manufacturers can better manage uncertainties and make informed decisions for sustained success. All right, thank you for your time. Any questions?